Hey, good morning, troopers. Hopefully sound should be coming through nice and clearly now. I've got the screen share active, so you should be able to see my screen. You're going to have to excuse me this morning a little bit because I have a sore throat. I'm almost about to lose my voice. So if you hear a lot of coughing in the background, it's just that. I'm not sending signals to anyone with these coughs. All right, let's get started. Right, so it's Tuesday, the 5th of August, 2013. Hope you've all had a great weekend and spent a little bit of time away from the screens. It was an electric calendar last week, right? We had all those announcements from the central banks. We had the non-farm payrolls figures, and you know what it's like now when NFP comes out below 200k. It's almost like, it's a bit disappointing that less than 200, just 150,000 new jobs created. So bit of a disappointing NFP, despite the fact that there were fairly positive numbers, and there have been positive numbers for a very, very long time, right? But generally speaking, at this point, the NFP people want it high. But this week likely to be just as electric. We've got a number of different items on the calendar which are going to be well worth watching out for. Maybe not so much today, but certainly from tomorrow onwards. In the early hours, we're talking GMT, but it'll be late in Australia. You have the Reserve Bank of Australia. Due to release its latest monetary policy decision, widely expected to hold at 2.75%. But recent speeches from members of the Reserve Bank, they haven't really ruled out further cuts, right? It's just something to be aware of. It does tend to be, these kind of levels for interest rate from Australia. It does tend to reflect the lows or the near lows. I don't think anyone's really thinking that it's ever going to go below at 2.5 or 2 or something like this. Like you're already kind of hitting all-time lows, right? But it hasn't been ruled out. It hasn't been ruled out completely. Just kind of be aware of that. The other thing to note as well is that, say they are at the end of a rate-cutting cycle, it does not mean that it's the beginning of a rate-raising cycle. All right? So you have to think about it just a little bit, with just a little bit of a clear head. And sorry guys, can you just excuse me you're going to have to excuse me one moment. Hold it guys. The UK, or you're looking at the example of the States, as far as rate cutting cycle is concerned, that ended years ago, but we're stuck in these lows. And as far as the BOE is concerned, and as far as the Fed has been concerned, for a very long time, the general kind of expectation, they're going to stay low. They're not about to shoot off into the sky in the near term at all. There can be a significant gap between those events. So just kind of bear that in mind. As well, tomorrow we have employment figures coming out of New Zealand. Ordinarily not that significant, not very important, but considering the kind of moves that we had overnight on the Kiwi crosses, they were a little bit crazy, right? There's the Kiwi, it was like 100 pip gap. The best one actually was Pound Kiwi. Pound Kiwi was a 200 pip gap, right? It was a 200 pip gap. So, it's a little bit crazy there. But maybe guys will start paying attention to some of the numbers coming out of New Zealand in order to justify the technical perspectives which they are developing. All right, so and we'll take a look at some of these charts a little bit later on in the presentation. But apparently, this is all to do with milk. Apparently, right? If Bloomberg is to be believed. So, there's some talk about Russia and China banning imports of whey powder or milk powder from New Zealand because they found some deadly bacteria in it. But and as far as I understand, actually, there hasn't been any official announcement about this either, right? There hasn't been any official announcement. So it was very much a kind of move on the back of, I guess at best you could say, until it's confirmed, may well just turn out to be conjecture. All right, maybe there is no ban. We're just going to have to kind of wait and see. But we'll come back to these pairs to look at the technicals in a short while. All right, highlight of the week. Highlight of the week on the calendar, I think, is going to be Wednesday. We have the Bank of England inflation report. The Bank of England inflation report gives inflation projections and critically as well economic growth projections for the UK. And I think those cover a couple of years, cover like a 2-year range. There's been a lot of positive, not necessarily data, but a lot of positive sentiment from the guys who collate indexes in the UK recently. All right, so we've had the Confederation of businesses. You've got CBI. They've been talking very positively over the course of the last 6 months about the UK economy. We've had this body which represents, like 60%, 7% of the UK accounting firms. So, they're looking at company data directly. And they're coming out very positive. And, there was talk over the weekend from some of these bodies that just in this third quarter, there might be a 1% gain in UK GDP. A lot of very positive talk has been coming for a long time from many of these bodies. On Wednesday, we get to find out what the opinion of the Bank of England is, and as well, if they're going to be giving some forward guidance about the state of play when it comes to the asset purchase facility and interest rates, and if or when their expectation is that we're going to kind of turn the corner as far as UK growth is concerned, and we can start expecting a more steady rate of growth. On Thursday, there's a Bank of Japan press conference which is scheduled. Might happen, might not happen. We'll wait and see about that. But like on Wednesday, I think that is going to be the kicker this week. That's the one. That's the one to be watching out for. All right, let's turn our attention towards the charts. I guess it's why you're here, really, not to hear me natter on about fundamentals, but always good to know as a guide what's on that calendar and what could spark off from volatility. What we're going to take a look at, let's take a look at yen crosses, take a look at Aussie dollar, take a look at Euro GBP, and then we'll take a look at the Kiwi and the Kiwi crosses if my voice holds out that long. All right, let's get started. So USD JPY, and the yen crosses. Look, the story and the theme with the yen crosses is the same that it has been pretty much the whole of this year. Alright, which is that as far as structure is concerned, we still have a very, very bullish structure on USD JPY, and that structure remains intact. It's more a question of technically, or it's more a question of how and when you would take a technical entry in order to get involved in trading this particular pair. That is more so the issue. From a few weeks back, we constructed a channel on USD JPY, or rather what we assumed would become a channel. It was a presumptuous one. It was predicted, a predictive channel on USD JPY. And right now, the prices come and she's sitting on a lower wall of that predictive channel, right? And considering that we had only used a single point in order to construct that channel, when the price returned here to see that reaction, that's quite sweet. And that's a nice sweet reaction at that level, showing that this wall may well be significant. So what are the options here, right? And it's a technical play now on this instrument. What are the options? What I'm looking for, there's always two options. You know what? She's either going up or she's going down. But it's the bullish scenario which I'm interested in. So what I'm doing now is I'm taking an upper trend wall and I'm saying if it happens, if it happens that the price ends up breaking up through that wall, and then on the pullback, or even on the breakout, I will buy this instrument, looking for an extension towards the upper channel wall. She's at the right type of place to do that from now. Alright, she's at the right type of place to do that from now. So that's, if we get the rally. If it happens that she's breaking down, I'll be sitting aside, but if you are bearish on this instrument, then there's no reason why you can't be looking towards the lower channel wall, as long as the price is not breaking out through that resistance, right? So if you have a bearish perspective on this, you'd be targeting the lower channel wall, as long as that resistance is not taken out. I'm trying to keep in line with the general bullish sentiment that developed over the course of last year and the beginning of this year. We're still to see that materialize this quarter, but if it's going to happen, then it'll be either in this month or next month, right? If it's going to happen, it'll be in August or it'll be in September for this quarter to turn bullish, and that's what I'm kind of looking out for. I get a break from the resistance I'm in, and I'm quite happy to follow any signs of bullish momentum that I see develop on this pair. And that is the case, you know what, as long as I think we'll remain above 93. So we've got quite a nice support wall probably being established here now, and I'd say, you know what, as long as we're remaining above that support wall, then I'd be quite happy. I'd be quite happy to maintain a net bullish bias on this instrument, not changing into a bear just yet. Really, we need some structural change in order to justify the default position as being bearish. Right now, if you are bearish, you've got to consider it still in a counter-trend context. Still got to consider it in a counter-trend context more than anything else. And if it happens that you end up getting a swing out of it, you know what? You just got lucky. Right. So any signs of bullish momentum, I'll take it. If she's falling, I'll let her finish falling. I wouldn't be getting involved. If you're looking at the other yen crosses, generally speaking, they're all telling the same story. This is GBP JPY, and again, there's a support structure which has been established here. It's in quite a wide range, extends all the way down towards the 46 handle, but as long as the price is remaining above that block, then what you've got to be looking for reasons to be buying rather than reasons to be selling this instrument. In the same light, again, we've got the Euro JPY, and here we've got support which has been established at 24 handle, and as long as the price is remaining above that level, technically the bullish momentum remains intact, even if the price is moving down towards that. Alright, so you just have to kind of keep that in mind. If you see those levels breached, you get a pullback, you get some resistance forming, you might say, you know what, structurally there's a change taking place here. But, I'm not sure. I don't think that we've necessarily hit the ceiling just yet. We're heading into these summer months. Flows can be a little bit light during these months. You really have to be careful how you position yourself, and you have to watch your exposure a little bit. The market's really proved that over the course of the last month, particularly on these pairs. So it's more a case of keeping perspective than anything else. But if you get those bullish rallies, I still think that they're worth chasing. All right, what else are we looking at? AUD USD. Here we go, Aussie dollar. All right, so Aussie dollar, she's fallen quite a lot now from those highs. She was up at 106. This morning she's been bouncing off of 89. We've had a collapse here, which is to the tune of 1700 pips over the course of the last 4 months. Last week when I was looking at this instrument, we were talking about 93 as resistance, and that level held up fairly well, and the price collapsed 400 odd pips from the 93. But there are signs on the smaller time frame, not the H4 here, but the signs on the smaller time frame here for Euro US, for the AUD USD that she may well be showing some signs of exhaustion here at 89. So at this moment in time, I'm looking to get involved in a long on AUD USD as a counter trend trade to the upside, targeting first the 90 and then the 91 handle, and if she chooses to extend further, she could head pretty much back into this range up towards the 91.50, where we have actually we've got this resistance coming at 91 flat, and that would become the target to the upside on an intraday basis, or maybe on an intra-week basis for the AUD USD. So let's just mark the level. This is what we're looking at. Alright, so maybe just use the break trigger. The price as well is in the weekly opening range, right? So our weekly opening range is here. If you choose to take the counter trend, long on AUD USD, then what you have to do is use the weekly opening range in order to determine the net bias. Right, so we've got our weekly opening range. I've just kind of boxed that area off roughly. So we get involved in this counter trend long hourly break above that level. We have quite a significant decent target towards the upside, a couple of hundred pips almost. If it happens that the price ends up breaking below that weekly opening range, it validates that net bias. All right, so we're going to use the direction of the week in order to determine whether we're in this trade or whether we're out of this trade. That's going to be that's quite important. It's important because we're recognizing from the offset that it is a counter trend trade, right? So that's how that's going to be played. And as well, what's your exposure on that as well? There has been strong momentum to the downside, so when you're looking for a reversal, you always do that with a little bit of caution. When you're looking for continuation, you can always choose to be much more aggressive. Okay. What are the signs of exhaustion? It's a technical issue. I've got a wedge, and I've got the intersection of that wedge here at 88.90, and from historical experience and observing wedges and the intersection of wedges, you tend to get price exhaustion at the intersection, right? So she's sat on this intersection, and so that's a level I was watching. She's sat. The price is reacting at that level. It's reacting in a way that I like, and this is the way that you play levels. You choose a level. If you see the price reacting at that level, it tells you the level significant. Then you can play, and that's what I'm looking to do here. She's reacting at a level where I was looking for a reaction, so I'm prepared in order to play this instrument. Interestingly enough, it's not a very clean wedge. There is a level which is just lower than that, which is coming in at 88.10, right? So, considering that we're in the weekly open range and we're breaking just above the weekly open range, I think it does make it a play. If it breaks below that, I would exit, and then I would watch 88.10 to see if we can get a reaction at that particular level. All right, so that's the Aussie dollar. Like I said last week, we were looking for the short play at the 93 handle. The price collapsed from there 400 pips. At the beginning of this week, looking for a counter trend rally up towards the 91 handle, and as long as the price holds above the weekly open range, I will be prepared in order to attempt to play that. Euro GBP, next one up. Alright, Euro GBP. Last week, not last week, but I was here the week before that. If you want my last week's notes, they're on my website. But from a couple of weeks ago, we started talking about initiating a long position on Euro GBP. We started initiating long position at this price here. That's coming in around about the 86 price level. We had quite a nice rally over the course of the last 2 weeks. She extended about 180 odd pips, right? Now, if you've ever traded Euro GBP, then you'll be very familiar with this idea that, 100, it's like 10 pips on the Euro GBP, sometimes is like 1,000 pips on any other pair, alright? So, the fact that we got 180 pips on Euro GBP, that's like 18,000 pips on any other pair, no kidding, right? But last week before NFT, we decided to close out the majority of our positions. We've taken quite a lot of positions, and we've added a lot of positions taken, and we just wanted to reduce that risk exposure. It looks like it was quite a wise decision to do that. I've held on probably one position in Euro GBP at the origin, but the stop on that is above break even, and in all likelihood, looking at where the price is right now, it looks as though even that position would have been stopped out now. And what does that mean if you've been following this story in Euro GBP in terms of bias and in terms of trading strategy? Those are the key kind of issues now. Well, as far as the bias is concerned, we established our bias using a trend wall. So we joined the support with resistance, and if you remember last time I was here, take a look, we've got this trend wall, and as long as the price is able to remain above the trend wall, then we would consider the bullish momentum to be intact, and if it happens that the price ends up breaking below that wall, then at that point you consider bullish momentum to be invalidated and potentially the beginning of a bearish move on this particular instrument. So it's about the wall on Euro GBP. The only issue that we have right now is that, we were taking our entries at around about 86, and we were taking our entries at around about 86, and we took our entries after some bullish momentum developed. Right, so the bullish momentum developed, we had a little hook here, establishing support and potentially told us that maybe there's an SR flip taking place at this 86 level. It was fair to look for a continuation in that bullish momentum. All right. Right now, what's going on is that the price is falling. Right, we're getting some bearish momentum developing right now, and you know what? She's fallen 140, 150 odd pips. On any other pair, that would be like 15,000 pips. So I'm not thinking about buying the dips on Euro GBP. Right? I've got an idea of thinking, as long as the price remains above the wall, I will remain bullish. But I want to see a bull rally in order to get involved. Right now, I want to see 86 hold in order to get involved. If 86 is going to be an SR flip. So we've got resistance, we had support. I want to see the 86 hold. If I see the price rallying back up through 87, I'll start getting interested again. But what I'm not going to do is to jump in front of it while the price is falling. I think the risk definition is too big in order to allow that to happen. What I mean by that is, even if I'm taking an entry now at 86, believing that this is just a dip and 86 is going to hold, I'm going to need a stop in the region of about 150 odd pips to prove me wrong on that trade, i.e., my bias would not be invalidated unless the price fell below that wall. Hope that's kind of clear. Right? So I don't like that. I think that's too much as far as risk definition is concerned. I'd rather wait for a bullish rally. If there's a bullish rally, you get an hourly break. You just need to use the height of that hourly candle in order to place your stop loss. Even if at that time your stop is inside of this range, but at least you're chasing a bullish momentum. You're looking for a follow-through. It's unlikely for the price to pull and hit your stop. Whereas when the price is falling and you're trying to buy, you just have to be a little bit careful, man. You have to be very, very careful with that. So, she's falling right now. I'll let her finish. I'll look at 86. If she breaches 86, I will look again at the wall. If she breaches the wall, I will start thinking south on this particular instrument. Okay? She's given quite a nice run. If she breaks, if she starts rallying again, she's above 87, 87.20, 87.50, buy. Alright, buy at that point. Once she's rallying, once she's proving that she wants to head up and she wants to break through, and then she wants to kind of break through that level. But don't be assuming it. Big news coming on Wednesday, like I said, it's going to be electric. I think that's the one that everyone is going to be waiting for. A lot of positive data, like I said, well, not necessarily data, but a lot of positive sentiment in the UK recently. Maybe that's going to add some value to the pound, in which case the long on Euro GBP may not be such a great idea. Right? So Wednesday, I think, is going to be the one to watch out for. But we're watching 86 and we're watching the wall. If we get our reaction at those levels, will start getting interested again, particularly if she rallies. If she rallies before hitting those levels and she's breaking up through 87 and popping 87, then we could pretty much go and buy blindly at those particular levels. Okay, last up, what's left to go? Just the Kiwi and the Kiwi crosses. So here is the humble Kiwi dollar, and I guess there's a couple of words of note which I always bring up when the market gaps. Always bring this up when the market gaps, right? Because the assumption tends to be that a gap is going to close, which is fine. If you like your kind of 50-50s, a gap closing is a little bit beyond that. It just tends to be more a question of timing than anything else. What you have to realize, though, is that once the price has made a move in order to go and close that gap, and not every gap closes, sometimes you get runaway gaps. Quite often, once the price, like we've got going on here, is like, that's the high that we've hit right now, that's last week's closing price. She was just shy, like maybe 15, 20 odd pips. It's not necessary that that gap is going to close completely. It may happen, it can, it's fine, but it's not necessary that it's going to close completely. So, once the price is covered, the majority of the gap, and it's going to fill the greater part of it, don't keep playing that kind of technical gap fill strategy blindly. Right? It's going to fill the greater part of it. That part of the technical play, that part of your trading strategy is over. It's done. And that's what we're looking here at Kiwi. Now what you have to do is revert to good old technicals, good old generic biases. And the best place for you to be able to establish a generic bias from is not this week's opening price, which was here, but from last week's closing price, which actually is here. That's coming in at around about the 78.30 area. You just box off those candles there. And what I would say is, from a technical perspective, as long as the price remains below 78.30, then actually Kiwi dollar remains a short. Only a break through that level, and then you can take a net bullish bias on this particular instrument. And if you do take a net bullish bias on this instrument, then there's no reason why you would not be looking for a retest of the 79.40 area, which is where you had your last support turn resistance. Okay, it might take about 4 days for the price to reach there, but if it's going to happen, she needs to contend with this 78.30 handle first, which is where the net bias is going to be established from on an intra-week basis. Particularly considering as well that we're still pretty much at the beginning, that we're still at the beginning of the month too, right? We're still in, these are the first throws of August, and these ranges tend to be more significant at the beginning of the period that we're looking at. Alright, so generic bias from last week's closing price, 78.30 on the Kiwi dollar. Similar application, Euro, NZD, GBP, NZD. We played the shorts to fill these gaps overnight. It was like a quick, there's a quick few hundred pips overnight. It's really a gift gap more than anything else. It was like, it was a bit of a gift for this one. Look, as far as the analysis is concerned, as far as the technicals are concerned, it's exactly the same. We've got last week's opening range, that's coming in here, rather last week's closing range, which we consider to be this week's open price. So we don't consider the open to be here. This is the open, and the price gapped higher. That's what happened. That's how you describe it. You don't say the price opened higher. It actually, quite often the terminology that you use ends up affecting the decisions that you make or the way that you establish bias. So we're establishing our bias from last week's closing price. We consider that to be this week's open price. As long as the price is above that level, the week is bullish, right? And we don't want to fight a bullish week. If it happens that the price ends up breaking down below that 69.50 handle, and below 69, at that point, the week turns bearish, and at that point, it would be more reasonable to say, you know what, we're looking for a follow-through to the downside. So the default position at these levels is to be looking for long trades. Only a break below the 69.60, 69.50 handle, a break below that closing range would justify short positions on this particular instrument, unless you have a different technical reason for initiating it somewhere, which is giving you a short bias. But that's how GBP and ZD is working. Euro in, that's Euro in ZD. But if we look at GBP and ZD, same story, right? That it's not about the gap and where the price opened with the gap this week. It's about last week's closing range. And in this instance, that's coming in at 95. So as long as the price is remaining above that level, then technically the bulls remain in charge. If you're looking to be playing the short, saying, well, the gap hasn't closed yet, she's closed significantly enough to the point where she doesn't necessarily have to close the remainder of it. Okay? So, no blind shorts on this at this stage. If you did a blind short last night, you're fine. You're good to go. But at this stage, I wouldn't be thinking blind shorts. I'd be thinking about bias and how we're establishing bias. I'd be thinking about the delta and how we measure that delta. And the starting point in order to measure change here is last week's closing price. So, some caution on these instruments. You really got to use that weekly open in order to establish a bias right now. Kiwi dollar, as long as she remains above that block, remains long, short only if she's able to break down below that particular level. Okay, folks, that is your lot this morning. I think my voice has managed to hold out. I'll live for another day, I think. Thanks very much for attending and taking time out to do that. I hope you enjoyed the presentation. I have a website. If it's the first time you're attending, it's wmdforex.com. I publish my trade notes on there each week. I will be back here for a live presentation in 2 weeks' time. You can pre-register on the FX Street website. Thanks as well to FX Street for providing the platform. And I'll see you all the next time. Cheers, fellas. Bye.